Hi, my name is Devinia Billings from the FAIS. Welcome to today's webinar. Today we will be discussing risk management with my fellow colleague Thandiwe Malefo. The reason why we chose the topic risk management is because we've noted that a lot of FSPs are good at assessing their clients' risks, but not their own business risks. So today, your business will become your most important client. So we'll be discussing section 11 to 13 of the General Code. We'll be looking at what is risk and risk management, the different processes, examples of the types of risk, and the insurance, which is the PI cover. Let's look at the overview of section 11 to 13. So section 11 deals with the control measures required. Section 12 relates to the specific control measures, and section 13 deals with insurance. What is risk? So risk is the possibility of a negative occurrence such as damage, injury, liability, loss which is caused by either an internal or external vulnerability. Risk management is a process of analyzing and assessing your exposure to risk and also determine how to best manage your exposure. So Thandiwe, what is your take on risk and risk management?
Okay, thanks, Devinia. Devinia, in looking at risk, I would like to use the illustration of purchasing a house, and I will use this illustration throughout our discussion because I think it's a relatable event that anyone can relate to, because I think either once in your lifetime you either aspire to purchase a house, have purchased a house, or still are in the process of purchasing a house, and I think it will be relevant to a lot of people. So in assessing the risks that would be inherent in purchasing a house, one will look at the kinds of the inherent risks that come about in owning in being a homeowner. The risks that would be applicable would be that there could be damage to your house. It could be exposed to flooding, or it could be exposed to a fire. There could be a risk of injury, that someone is injured in your home or you are injured in your home. There could be a risk of loss, that you lose your house due to affordability. And I think one relatable event would be the COVID-19 occurrence that happened to all of us, to the entire world. A lot of people have had to take salary cuts, and a lot of people lost their employment. So in the event that would have happened to someone, that would have been an external factor that they did not have control over, but it led to them losing their house and losing the income through which they would have been paying their bond. An internal factor that would have resulted in someone losing a house would be perhaps where they lose their job or get retrenched due to a company going under, or due to a company no longer becoming insolvent, the company that they work for becoming insolvent. Another external factor that we can look at would be a change in interest rates, where a person would have taken a house that is at their highest affordability and might not have wiggle room for any change of interest rates. And when we then look at the risk management, Devinia, we would then have to ask ourselves this question if we are purchasing the house. So as someone who's now purchased this house and I'm a homeowner, I need to ask myself, how do I then protect myself against damage on my property? The questions I would need to ask myself is that, what is the probability of a flooding happening, and what is the probability of a fire occurring? So I'd need to ask myself, if I live in an area that is close to a river, and do I then have enough drainage in my yard to ensure that my house doesn't get flooded? If I live in an area that is prone to fault fires, what are the mitigating factors that I have employed in ensuring that in case there's a fault fire, I am protected? Do I have a fire extinguisher? Do I have a hose close by that could, assist in mitigating the risk of the entire house catching fire? In case of an injury, we would look at what would happen in case a person who's visiting my house gets injured in my house. Am I appropriately insured against that? Do I have rails where I have staircases? Do I have, non-slip tiles in areas that are prone to moisture, in bathrooms, in kitchens? Those are the kinds of measures that you would need to take from a risk perspective, because there is a risk that I could slip and break my back. Now, another risk that we have identified that we'll look at is the liability. Now, from a liability perspective, I need to look at the cost of my bond. Is the cost of my bond higher than the resale value of my property? So have I assessed before purchasing this house what the resale value of the properties within the areas are, and if I will be able to actually recover my investment? And in the event that I want to then renovate my house, would this be a feasible decision? Would it be the correct decision to make? Will I be able to recover or recoup the costs that I have incurred in renovating this house that I have now bought? Now we would look at the loss. Internally, am I insured? If we look at the internal factors of the loss, am I insured against loss of income? So do I have a cover that covers me in the event that I am retrenched, or in the event that I can no longer work due to medical reasons? Do I have a cover that can cover my property in the event that there is a disaster that results in me losing my house? So say there is a fire. In terms of that fire, am I appropriately insured to ensure that this damage is paid by someone else, and that I have then transferred this obligation to repair the house? Devinia, could you please take us through what the legislation says and just unpack the rest of what the requirements are for us, please?
All right, so let us look at section 11, which is control measures. So I'm going to read it out. It states that a provider must at all times have and effectively employ the resources, procedures, and systems that can reasonably be expected to eliminate as far as possible the risk that clients, product suppliers, and other providers or representatives will suffer financial loss through the theft, other dishonest acts, poor administration, negligence, professional misconduct, or omissions. Let's look at section 12 and 13. Section 12 is the specific control objectives. It states that a provider, excluding a representative, must structure the internal control procedures to provide reasonable assurance that the relevant business can be carried on in an orderly and efficient manner. Financial and other information used or provided by the provider will be reliable, and all applicable laws are complied with. Section 13, insurance, states that a provider, excluding a representative, must, if and to the extent required by the register, maintain in force suitable guarantees or professional indemnity or fidelity insurance cover. Now let's look at risk management process. So it entails developing a risk management plan. It must be a working document and continuously reviewed. Also consider the FAIS and FICA and all other applicable legislation to the FSP. For example, the Income Tax Act, National Credit Act, Labor Relations Act, and the Closed Corporations Act. There's also other factors to consider and always to customize. So Thandiwe, when coming to other factors, can you please dig deeper for us into this?
Okay, so other factors that the entity needs to consider is not just the legislative requirements, but they need to think of disaster management. They need to think of their financial risks. They need to think of their data risk, their security risk as well. So I will go into an example of market risk. So if they're looking at market risk, it means that they need to look at their surrounding factors and the sector in which they are operating. They need to look at their competitors, what their competitors are doing. They need to look at the latest innovations, whether they are correctly geared to take on these new innovations, and where there are new entrants such as fintechs, are they appropriately structured to be able to perhaps accommodate a product that could, that could compete with what the fintechs are offering and on the same platforms. And from a product perspective, where there are product innovations, are they aware and are they staying abreast of all the new product offerings, and are they getting their clients the most affordable products possible? Because this will then impact on their financial risk, because if they do not manage that risk effectively, they could possibly lose their market risk, they could lose their market share, they could lose their client base, and they could lose some of their staff to entities that are actually working on more innovative products and that are more ready to deal with these innovations.
All right. And then the following steps may assist the FSP to develop a risk management plan. So that is step 1, to identify the specific risks. Step 2, analyze and evaluate the risk identified. Step 3, manage the identified risks. And step 4, monitor and review the risk. So Thandiwe, can you take us through these steps in more detail, please?
Okay, so Devinia, as I mentioned earlier, I will be using the same example as what I had given earlier in terms of the house. So when you look at the analysis of the risk, you need to ensure that the analysis of the risk is tailored to the size of the FSP and the nature of the FSP, as well as its operations. You need to ensure that the risk is assessed, the probability of the risk is assessed, and that it is measured and rated or categorized based on the probability of that risk being realized. So we will look at the risk rating of the particular risk. You would need to say as an FSP if the probability of this risk occurring is either low, medium, or high. Where a probability of a risk occurring is low, you would apply fewer measures in mitigating that risk, because this risk has proven to be low for you. The probability of this risk occurring is low for you. Where the risk of something is high, being realized is high, you would ensure that your controls are very stringent and that you manage this risk very closely, because you want to ensure that this high risk is mitigated to a lower risk as much as possible. And in the risk rating process, you will allocate a score to the risk. You will have, a grid where you actually can then say how you will treat different risks based on the score that you've given. And when I say how you will treat the different risk, it goes back to when I said with a lower risk, where the probability of a risk is low, your measures and your control measures will be slightly less stringent, and where the risk rating is high, your measures and controls will be slightly higher. And now, Devinia, the next step that we will look at is managing the risk. So after you analyze and evaluate your risk, you would have then measured your risk. You then look at how you then manage your risk. And in managing the risk, there are 4 strategies that FSPs can elect. They can choose to accept the risk, and in accepting the risk, they are accepting the risks that come with actually getting into this transaction. So in the example of the purchase of the house, when I purchase the house, I'm accepting the risk that there could be damage to the house, that there could be due to a fire or flooding or a natural occurrence like a hurricane or an earthquake. There could be damage. There could be injury that occurs in the house to a person that visits my home, or to the people residing in my home, so to myself and my family. And then there could be a risk that I could lose the house because I can no longer afford the house, or I could lose the house because I can no longer afford the interest that is borne on the house, or I cannot afford the costs of fixing the house due to damage. And then there's also now the risk of falling into more debt, where I now decide that I would like to resell my house and I would like to perhaps purchase another home that is slightly bigger to accommodate for my growing family. And in that case, I would need to assess if I run the risk of of being in debt because my bond costs are higher than what the value of the house is at resale. Now, the next strategy that we can employ is to mitigate this risk. Now, all of these risks that I have chosen to accept at the top, I would then have to say, I have accepted all these risks and that they could occur. But then how do I mitigate these risks? I need to then make sure that from an affordability point of view, I do not contract for a house that's at my highest affordability, that I leave some wiggle room for the interest rates growing, and that should the interest rates grow, I can still afford my home and I can still afford to keep everyone in my home. And in the instance that someone is injured in my home, I would have to then ensure that I am insured for third-party liability, that should anyone get injured in my home, I am appropriately insured for that. And I would need to ensure that I make sure that I put in non-slip tiles, I would put in rails where I need to put in rails, those kinds of factors. So the same things that I would have mentioned earlier, those are the same controls that I would apply in mitigating the risks of any of those risks being realized. And now the next management approach that we can use to risk is to avoid the risk altogether. And in me avoiding damage and avoiding liability and avoiding loss or avoiding, unfortunately, we cannot avoid injury in this instance, I can choose to rent. So I could still get injured in a home that I choose to rent. So I can avoid the liability and the cost and the loss and all of the other risks that we've identified, except for the injury, by actually renting out a home instead of owning it. Then in the event that I lose my income due to retrenchment or due to further restrictions imposed by, say, a second wave of the COVID-19 lockdown, I then will not be left with further liability in the instance that I lose my income. So that's another way that I could avoid the risk. And now the next approach is to transfer the risk. How I can transfer the risk is to ensure that I am appropriately insured for every single risk that can occur. So I am insured against the loss, I am insured against injury, I am insured against any liability or any shortfall that may exist between my bond costs as well as my resale value of my home. And again, another way of ensuring that you don't fall into liability is to make this assessment before you purchase your home. Now, the one thing that a lot of FSPs and a lot of businesses unfortunately don't look at is the continuous monitoring of these risks, because a lot of FSPs go into the identification of the risk, they go into the analysis, they evaluate the risk, but then they fall short in the management of the risk on a continuous basis, as well as monitoring the change in the risk. So it's very important that the FSPs ensure that they look at the inherent risks of the entity on a continuous basis and assess if the risk that may have been posed to the entity at the beginning of its assessment when it started drafting its risk management plan is still at the same level that it was initially. So they would need to look at whether the risk has not moved at all or if the risk still exists at all. Devinia, can you please then take us through unpack more of the types of risks that we can have?
All right, Tanya, I just have one question for you. Why do you think that the entities actually ignore the last two steps? Do you think there's a specific reason for that?
You know what, Devinia, I think the entities just get so absorbed in generating their income and their business that they focus so much on the entities that they are servicing, that they forget to look after themselves as an entity, and that they forget to appropriately look at the risks that are that are being posed to them. So they do not continuously look at the threats that exist and whether there are new threats due to, say, new entrants in the market or a change in technologies. And that's just something that needs to be I think deep rooted in the FSP, that they need to look at this process as a working document, as a continuous process, that they continue to relook at themselves as a going concern and as a company that evolves with time.
All right. Okay. Thank you so much for that. All right, so let us look at the types of risk. So we know that you have to identify the risk, specific risk to your FSPs, and it needs to be tailored. So there are different examples of risks. There's compliance, financial, human resources, operational, litigation, reputational, and market. Thandiwe, can you please give us an example of each of these risks, what it entails?
So we'll start with compliance risk. And Devinia, compliance risk is the risk that the FSP or the entity itself does not adhere to its own policies and procedures, that in its operations, it does not conduct its operations in the manner in which it has contracted with itself that it will. Now, the risk of the financial risk now occurs where the performance of the business does not sufficiently cover its obligations. This may lead to a position where the entity's assets are now lower than the entity's liabilities, in which case the entity will be rendered insolvent. And it's very hard for an entity that is insolvent to convince someone, especially in the financial sector, to convince someone that it's trying to generate wealth for, that it can generate wealth for that person when it can barely stay afloat of its own financial soundness requirements. So that would be a financial risk that an FSP may face. Now, an example of human risk or staff risk would be an example where the staff does not meet its CPD requirements and it does not meet its fit and proper requirements of honesty and integrity. So where it does not meet its fit and proper requirements of honesty and integrity, there may be a threat that the staff may defraud the clients, may steal client information, or use the information fraudulently and in a manner that can result in a client incurring a loss. Another example of where the staff has not met their CPD requirements, what it then translates to is that the representatives then are not up to date with the most current product information, that they are not competent with the product offerings, and they may then give misleading information to the staff, which may then impact the reputational risk of the entity. The reputational risk of the entity refers to the credibility or the trustworthiness of the entity. Clients and suppliers need to feel assured that when they deal with the entity, they are dealing with someone who will stay true to the promises that they make. So when they contract with this FSP, they need to trust that if I contract with this FSP and I take a certain product, I am assured that I am getting the best possible service. I am getting the most professional service from its representatives. Now, there's also operational risk where the FSP is risking not operating according to its business objectives. The FSP may have, according to its targets, objectives that it wants to meet within a certain timeline. But if it does not stay on par with its strategies and its objectives, it may run the risk that it may not meet its business objectives according to the timelines that it may have set for itself. There's now litigation risk. There's risk that should an entity be taken for legal, should have legal proceedings against it, either from a client or a regulator, that they could run the risk of making a loss or incurring further liability. The entity needs to ensure that it is appropriately insured against such a risk, and it needs to ensure that it adheres with all its regulatory as well as all its client obligations in order to ensure that it reduces this risk to a low level as much as possible. And now lastly, there is market risk. The market risk then looks at the competitors, the clients, the product offerings, and anything else in the FSP's environment that can affect its profit share or its market share. So the entity needs to ensure that it is continuously abreast of all the innovations and changes in its environment to ensure that it does not lose its client client base, and that it does not lose its integrity in terms of offering the best service possible, Devinia.
Okay, thank you for those wonderful examples, Thandiwe. Now, Thandiwe, what is a PI cover? And where do we find this rule to have a PI cover?
Devinia, so the professional indemnity cover is a cover that every professional needs to take against the possibility of being of having any legal action taken for professional negligence. So as a FSP, there is, by virtue of being in the financial industry, there is a possibility or the risk that any of their representatives could have given a client information that may have been misleading, that may have been incomplete, or that may not have been suitable, or advice that may not have been suitable for the client. A client could have been led to take a product that is not affordable to them, or that does not appropriately cover their needs. And in the instance that this client wants to ask for recourse because they have made either a financial loss or they feel that their objectives were not met, and say an ombudsman or a regulator rules in favor of the client, a FSP will then need to claim against this insurance cover to ensure that they do not incur more liability. And this liability is usually assessed by the entities that offer this, by the insurers that offer this insurance, based on the environmental factors of the specific FSP. So it's not a one size fits all measure. They actually look at the clientele, the kinds of products that it's offering, the providers that it's working with, the values of the products that it has, and then they assess the possibility or the contingent liability that may arise from the level of the book, or the level of the product that the FSP may have issued. And it's very important that the FSP ensure that they take the highest cover possible for what their liability is, and that they do not fall short on that.
Okay. Well, that is it. Thank you so much, Thandiwe, for your time. And thank you to everyone for joining us and listening. Please do not forget to add any comments on the future webinars, anything that you'd like to see. Thank you.
Thank you, Devinia.